Joining us right now to talk more about all of this is Barry Knapp. He's managing partner and director of research at Ironsides Macroeconomics. Also, Krishna Memani, who is vice chairman of investments at Invesco, and our guest host this morning, Richard Fisher. He's the former Dallas Fed president. Richard, of course, is currently a senior advisor at Barclays. He's also a CNBC contributor. And gentlemen, welcome to all of you. Richard did a great job of just setting this up. What the negative impact would be, or what the positive impact of lower interest rates other places has been for us, and that's the corporate bond market and the U.S. equities market. Barry, if the Fed did what President Trump is pushing for and pushed interest rates down to zero or below, would that mean that our stock market would either correct, collapse? What do you think would happen?
No, I don't think it would cause the stock market to collapse necessarily. It's pretty clear that our bond market's a major beneficiary of the diminishing supply of safe assets globally, right? So this is far more true this cycle than it was even prior cycle. That's probably the best paper that was presented at Jackson Hole this year was from a guy named Krishna Memani about the supply of safe assets. And so that was a major contributor through the risk-off event we had in August to pushing rates higher. I don't think that the stock market would collapse at all. I'd like to add a point, though, with respect to the dollar. I think what's commonly misunderstood about what happened in 2014 to 16 is there's two effects when the dollar rises. And in that case, the trade-weighted dollar went up 25% over the course of 18 months. So there's a translation effect just when you translate those revenues and earnings back to U.S. dollars that clearly slowed and contributed to the earnings recession we had during that time period. But then there's a competitiveness effect. And what's clear is, even with that 25% increase in the trade-weighted dollar, there was no loss of competitiveness for U.S. technology companies or even industrial companies, because as soon as the dollar stabilized, it didn't need to reverse, just stabilize. Their margins, earnings, revenues came right back. U.S. companies do not compete in price-sensitive, commoditized products globally. So the dollar going up is not a negative for the U.S. at all. I would argue it's a positive, and it's just completely wrong to think otherwise.
Well, I think the impact of the dollar is a little bit more than that. I think competitiveness is certainly an issue, but I think dollar certainly gives you an indication as to which way the wind is blowing in terms of flows. And when you have the dollar going up, whether that is causing a kind of a drawdown in the markets or not, it doesn't really matter. What that is telling you is that a lot of times the flows are coming into safe assets where the nominal yield is quite good. So that, I think it's definitely the best weather vane that you can find in the market. So coming back to negative rates, I think that's an interesting topic to explore, because ECB will be doing something in not too distant a future. I think while we may not like it, and we may pine for other things like fiscal measures people take, nobody's doing anything on that front, especially Germany. They can do a lot, but they are not inclined to do anything. In light of that, I think the only game in town we have is the ECB. But as far as I'm concerned, picking between Trichet and Draghi, I'm Draghi all in, because at the end of the day, it was Draghi's QE policy that saved the Euro project in a meaningful way.
So Becky's friend, Warren Buffett, likes to say, when the tide goes out, you find out who's swimming naked.
Here we go.
Don't want to embarrass you.
Naked stay with these. We just had a segment on this before. Can we stop?
No, but here's the point. What ugly credits have been hidden by this sea of liquidity, and what happens when it recedes?
Is it ever going to recede? Maybe the question. Are we ever going to see anybody naked ever again?
Come on. We know that there are ugly bodies floating in that sea of liquidity there. It's not just in Italy. It's everywhere. The banks have been hammered. It's pretty hard for me to argue this has been beneficial.
Well, so
now, you could say the positive argument, it could have been worse.
Exactly, but that's something we cannot ignore. That is, think about it. When the Fed was tightening policy in 2018, what were we talking about? The fact that tightening of policy is having a meaningful impact, and when you have a 10% drawdown in the equity market, that really hurts people, and that certainly hurts the economic outlook and what people do from an investment standpoint. So this is real. The fact that we haven't had a significant drawdown, in my mind, is a positive as opposed to a big negative. Again, Trichet, that was it's a liquidationist. That has whether that is correct in this day and age, I think we can debate till the cows come home.
Trichet had better hair.
Talking about it though, in terms of going from 2% Fed funds rate to 0 is kind of obscuring what the actual issue at the moment is, which is what are they going to do in September? Pretty much everyone knows a quarter point cut. Is that going to be it, and is that going to be enough, Barry?
I wouldn't answer the question about whether it's going to be enough because it's, in my view, it's completely unnecessary. And the real issue here is we're impairing creative destruction, impairing credit creation, ultimately weakening productivity growth. Like, look at bank return on assets in Europe relative to the U.S., they're half. Look at productivity in Europe, it's half of what it is in the U.S. So that's what the process does.
But again, isn't that kind of a straw man? I mean, if we go down a quarter point, we're not automatically Europe.
Oh, of course, of course. So I think that the quarter may be it, and the reason I think it may be it is because the mix of growth has shifted decidedly. What I was so bullish economically about in 2018 was that the Tax Cuts and Jobs Act boosted investment, particularly intellectual property investment, software, research and development. Productivity then followed on in through that year and into 2019. This year, though, we've shifted back to more consumption-driven growth. And now, if you look over the last 3 months, core CPI, core PCED are picking up. Yeah. Wage growth now looks like it might be being driven higher by a tight labor market, more so than labor market fluidity, that's turnover and dynamism. So if that inflation impulse does start to accelerate through the course of the year, the Fed's going to find themselves, the boneheads will find themselves between a rock and a hard place, right? And so that's kind of the issue. And I've been really quiescent, or had the view that inflation would be quiescent for quite some time, around correlation matrix around it, all these other things. There are exogenous factors pressing on it, except for housing. And housing's a very big deal because those shelter costs are starting to go up. That's the one sector exhibiting a Phillips curve this entire business cycle. So that could get them or take Dees off the table.
I think when we frame things as do we need that, whether it is necessary today or not, that's kind of approaching it slightly differently. One way to think about it, did they have to tighten in 2018? And if they didn't have to tighten, unwinding that, is that such a bad thing? Right. So our assertion would be that we probably do one in September, and if the markets and the economy remains where it is, where business investment is really not picking up after its sugar high, they probably do one more in October and one more in December. And if you think of it as an unwind of 2018 tightening coming off of a tax cut sugar high, it may not be such a bad thing.